Now moving on to another economic tool to help us achieve our macroeconomic targets. This is topic 5, and this is linked to monetary policy. Now let's very quickly talk about what monetary policy is. This is to do with interest rates. It's to do with the money supply, and it's to do with exchange rates. So in effect, you could determine it's looking at money. Now let's just think very quickly about what the functions of money are. So what are the reasons for money in an economy? The most obvious one is a medium of exchange. We know that every developed economy across the world, the most developing ones, it's based on specialisation. So people exchange goods and services for something that they cannot produce themselves. A medium of exchange means it's how people exchange one good for another. Hundreds, thousands of years ago, people used to exchange things through a bartering process, e.g. I think 6 of my products are worth 2 of yours, or I'll give you 1 goat for that product you've got there. Money means that we can put a value on something and exchange money for goods and services in an economy. Money is also a value of wealth. Okay, we're all obsessed with trying to become millionaires. Some people, lucky enough to be there, want to become billionaires. The amount of money they have represents their wealth that they have built up. Money is also a standard of deferred payment. So increasingly in today's economy, people buy things on credit. The value of that credit is how much money they owe that particular company for that particular good or service. Let's think very quickly about the supply of money. There are 2 different types of money you need to be aware of. We have something we call narrow money and something that we call broad money. Narrow money is money that's very easily accessible. It's something that you could access today if you wanted to. So this is normally money that you have in your bank account, for example. You can draw out with a cash card there and then. Broad money is money that's more difficult to obtain. It could be money you have in an ISA that can't be touched without notice. So it's money that you hold, but you cannot access it straight away. Let's think now about how we determine interest rates in an economy. I'm going to have interest rate as a percentage on the vertical axis. I'm going to have the quantity of money on the horizontal axis. Money supply, we assume to be fixed. This is the demand for money, and what we can see is then that where these 2 meet is what the interest rate should be. We'll call that R1. We see that demand for money is downward sloping, so as interest rates fall, demand for money will start to increase. Interest rates go up, demand for money will go down, simply because at higher interest rate, people would rather stick their money in savings to gain the interest than have it to spend. Lower interest rate, people will rather use their money, spend it, than save it and keep it in the bank, for example. If the demand for money was to move to the right, that could be caused by higher income. If people have got more income, they want to spend more. To spend more, they need more money. We can see that the impact of this would be for interest rates to increase all the way up to R2. I want to move on to the objectives of monetary policy. But before we do that, I want to establish the difference between a nominal interest rate and a real interest rate. A nominal interest rate is simply the percentage that you get on your savings. So an interest rate is clearly the cost of borrowing or the return on savings. So if I was to invest £100 at a 5% interest rate, at the end of the year I have £105. You could view that as I've made £5 profit on my savings. However, that's not necessarily true. money is only worth what you can buy with it. So it's the cost of goods and services. So a real interest rate will consider inflation. So again, I've invested £100 at 5%. That means my money is worth £105. With a nominal interest rate would suggest I've made a £5 profit. But if inflation is at 4%, 4% of my profit's been wiped out by inflation. I've only made a £1 profit. So normally economists prefer to use real interest rates as opposed to nominal interest rates. So at the moment in the economy, inflation's over 3%. Return on savings, if you're lucky, is 2%. You're making a 1% loss every year on your savings. The base rate is the Bank of England interest rate, currently set at 0.5%. Now let's move on to the objectives of monetary policy. The main objective of monetary policy is to control inflation. The Bank of England have a target of 2%. Now let's think about two different ways that we might use monetary policy. We've got price level and real GDP. So what we're clearly doing here is building up some macroequilibrium diagrams again. I'll stick on LRIS, so the maximum potential of the economy. So if our bathtub's full, if we achieve our PPB, we operate at Y star. If the economy is currently up here, operating at Y1, we can see that the economy has got high inflation. This is due to excessive demand in the economy, pushing prices up. This will occur at a boom in the economic cycle. Now what's likely to happen here is that the Bank of England, who set interest rates, are likely to have a contractionary monetary policy stance. So what they will want to do is to bring down aggregate demand in the economy. So they'll want to lower AD to AD1. This will reduce inflation, but will also reduce economic growth and potentially create unemployment in the economy. This will be done by increasing interest rates and/or reducing money supply. Let's take interest rates first of all. If we increase interest rates, it means that less people are likely to consume in the economy. AD is equal to C plus I plus G plus X minus M. Higher interest rates mean that people would rather save than spend, so consumption will fall. Investment will fall. The cost of borrowing will increase. It means people are less likely to borrow money to invest in their business or buy a new house, for example. This will bring down prices in the economy. So that is a contractionary monetary policy stance. Let's think about an expansionary monetary stance. So we would use a contractionary monetary stance when we're in a boom in the economic cycle. Expansionary will occur when we have low AD in the economy. So we know the Bank of England have a 2% target for inflation. When the economy is operating way below its potential at Y1, there's a chance we might have deflation in the economy. What we need to do is to give AD a boost. This will start to bring prices up to the 2% inflation target at P2. Bonuses, it will also lead to higher economic growth, Y1 to Y2, and create employment in the economy. This time, we will look to lower interest rates and/or increase money supply. We know that AD, again, C plus I plus G plus X minus M. If we lower interest rates, people are less inclined to save their money, they'd rather spend it. Consumption goes up. Cost of borrowing falls, investment is likely to increase. Also, people on variable rate mortgages will find that previous borrowing they've done will go down. That might mean that mortgage repayments go down, which frees up more of their wages to spend in the economy. So we can see here we'll have positive multiplier effects. So if I very quickly draw here the economic cycle, trend rate, economic cycle. Number 1 is a boom. Number 2 is a recession or a bust, so the troughing effect. When we're at number 1, we've got inflation. We need to contract the economy. This can be used short term to get us back to the trend rate. We can't go below this point with it because if we do, it will lead us to a number 2 bust. If we're at number 2, we need to use expansionary monetary policy to give the economy a lift. Again, it's short term because if we use it too much, it will lead to a boom in the economy. Now, we focus there on interest rates. Another part of monetary policy is to change money supply. What we can use are what we call open market operations. What we can do is we can go to banks and we can set limits on how much money they have to have in their bank to cover spending that they're doing. So if we would say, for example, say to a bank at the minute, you've got to keep 10% of your money back in your bank to cover costs that you might have. If we raise it to 20%, in effect what we're doing is limiting how much money the bankers have got to spend and lend out. That will in effect reduce money supply, which is a contraction in monetary policy, because less money people got to borrow will reduce investment. If we were to say to banks we will reduce how much money you have to save, it means the bank can lend more, promotes more investment into the economy. That's expansionary. Something else the Bank of England does, they can issue government bonds. If the Bank of England was to create 1 million bonds in the government, people can in fact invest money into the government. This will mean, in effect, that person is saving more. Higher savings means lower consumption and therefore contractionary monetary policy. Expansionary. If the government was to purchase lots of bonds that people already own in the government, in effect people are having money back from the Bank of England. This means some of them people get a big windfall amount of money from the Bank of England, which means they have funds available to spend on consumption in the economy. That was used recently called quantitative easing.